Hi, I'm Kristof Gleich, the President and CIO of Harbour Capital Advisors.
And I'm Jake Schurmeier, a portfolio manager within Harbour's Multi-Asset Solutions Group.
Welcome to this week's edition of Views from the Harbour, where we're going to do a deep dive into a number of topics this week. Firstly, we're going to start with earnings. We're in the thick of earnings season right now in Q3, and we're going to see what those learnings are we can learn from earnings and where we are in terms of the economic cycle. Then we're going to go back to my home turf in the UK, where we're going to look at how the bond vigilantes ultimately brought down a government of a G7 economy, which I think is absolutely sort of fascinating. We're going to discuss what's the latest there, what some of the consequences are there. We are then going to talk about China. We just had the Chinese National Congress meeting. Some interesting scenes that came out of that. And then lastly, we're going to talk a little bit about Fed, again, monetary policy, pause versus pivot. And Jake spent a number of years working at the Federal Reserve in New York. So he's really well positioned to tease out some of the inner thinkings of the Fed. So with that, Jake, why don't we jump straight in to earnings? We're maybe 40% through earnings season. What's your take? What are you seeing? What are you hearing? And what can we learn?
Yeah, so as expected, top line growth has remained strong. We're running about 10% year over year at the top line level. That's consistent with just the very high inflation we've seen over the past few years. However, the earnings side, we started to see some, deterioration in earnings there. There are tough comps coming out of kind of the burst out of the COVID pandemic. But, we're starting to see, some pretty large bellwethers miss, Microsoft, Google giving pretty poor guidance as well as poor earnings. And there's just been very few upside surprises. Netflix is one of them, but by and large, most of the earnings have been coming in lower. And now we expect earnings growth to be flat throughout the quarter.
And so as we sort of look forward into earnings, what can we read about the state of the economy? And I think it may be worth just taking a step back. A lot of this volatility that we've seen so far this year has really been driven by the backup in interest rates. And there's different factors that impact equity markets. It's what's the overall discount rate? How much should we be discounting these future earnings by? It's then there's this risk premium notion of how much should we be paid to and be compensated for investing in equities. And then finally, I think the third piece is the sort of the earnings outlook. And those three pillars are really important to sort of understanding equity markets and valuation. So why don't you unpick that a bit for us with a particular emphasis on that third pillar and where earnings may ultimately go?
Yeah, so, you hit it right on the head. There's, several questions going on here. And so I think we're transitioning out of that first period where, we're seeing the back half of operating leverage. So over the past year, you really saw revenues grow quite dramatically. You saw net income expand as well as margins were really expanding as labor costs remain low despite, nominal income and nominal prices growing pretty dramatically. And so at the same time, you've had the Fed tightening policy, hiking interest rates. And so what we've seen in terms of equity multiples contracting and broader equity indices falling has really been an interest rate story. Yeah. And so now we're kind of transitioning to that third part where we're getting to the other side of operating leverage. Wage costs are rising. Companies are getting less margin expansion. They're having to kind of think about volume growth versus being able to continue to pass on higher prices to end consumers. Consumers are beginning to trade down as real incomes have remained quite low relative to the nominal income growth we've seen. And so now, moving forward, we expect the further declines in the equity market to be driven largely by risk premia and kind of worsening earnings expectations as we've kind of gotten through the bulk of the interest rate increases.
And we're reasonably conservatively positioned at the moment in terms of risk assets because of this outlook that we have. Our central case is a recession for next year. Typically, markets rally before all the bad news has actually happened. Markets discount the future, not the present, generally. What is your best guess on when earnings? So it seems like earnings are beginning to show weakness this quarter. When do you think earnings may trough by? Is this a 6-month story, a 1 year, a 2 year? Can you sort of put some meat around the time horizon?
Yeah, so I think while we feel fairly confident about a recession being likely in 2023, we're less confident about that severity. But in terms of the timeline, we're starting to see wage costs rise, and those are only slowly embedded in labor contracts. Take some time to turn over. We haven't really seen any loosening in the labor market, so we continue to think margins and net incomes are going to be pressured through the first half of next year. So my best guess would be we see a trough in earnings by Q2 or Q3 of next year, assuming a more standard recession rather than the severe variety that we suffered in the financial crisis or even COVID. In the event that it is a pretty severe recession, you might push out the trough in earnings to Q4 of 2023 or even the first half of 2024 as that demand growth really starts to work through the economy.
And then as we're managing through this downturn, and again, you mentioned probabilities. There's no such thing as certainties in investing. It's always about skewing the probabilities. What are some of the areas of the equity market that we currently favor that should help sort of navigate through some of this volatility?
Yeah, I mean, our highest conviction pick has continued to be the healthcare sector. It has strong secular growth profile and pretty robust, healthy margins. And so we expect income growth to remain quite resilient to a downturn and still provide you a little bit of kind of quarter over quarter and year over year earnings growth going forward. Other sectors we've been thinking more about is technology. That's really been harmed by the sharp increase in discount rates. But we think again, these large compounders, your Microsofts, your Salesforce, companies like that continue to grow, have pretty robust top line growth and still have very healthy margin structures that we don't think are going to be severely impacted by higher labor costs going forward.
And I think it's interesting, like both sort of healthcare, technology, you mentioned there's sort of these bellwether, like steady eddies, large cash flow compounders. But then the barbell is for active management, I think there's also an opportunity to capture growth as well as some defensive characteristics. So let's just switch up the order a little bit. Let's jump straight to the Fed, just seeing that as that's so timely. Given your experience from working like inside of the Fed, what's your take on this unprecedented year of monetary policy tightening and the pivot from transitory to inflation is a real problem here, record number of interest rate increases. I think we've got another 2 Fed meetings left this year. How do you see the rest of this year playing out? And then ultimately, what's your read on next year's monetary policy backdrop?
Yeah, I mean, unprecedented is the right word, and it's something they've been saying themselves. And I think, that's the difficulty with forecasting inflation when you've had this really large nominal income shock coming out of the pandemic, all of the fiscal transfers. And I think the Fed would be the first to admit, we should have began tightening policy in 2021. Obviously, they did not start until the first quarter of 2022. And so they're behind the curve, and the rapid increase in rates and expectations for further rate hikes this year have really been them catching up. And so we think they're getting much closer to meeting the amount of policy tightening that they need. And so for the November meeting, we expect another 75 basis point hike. And probably
that'll be four in a row.
That'll be 4 in a row. And so for the December meeting, we expect it's more likely to be a 75 than a 50. But the Fed's now grappling with this difficult communication and policy decision of whether they can begin to slow down the pace of rate hikes while still communicating that policy needs to be tighter. And so whether that's switching to a 50 basis point hike in December or switching in January of next year, at some point they need to transition to a slower pace of rate hikes, because the way they think about policy is they need to observe the effects. There's a lot of uncertainty about what the appropriate level of interest rates is at any given time relative to this idea of a neutral rate. And so part of the policymaking art is thinking about, okay, we've made these past interest rate hikes. How can we see their effects? How is the labor market responding? Are we seeing better trends in services inflation?
And Jake, what is your best guess? I guess it probably is a best guess of the lag between the cause. Let's say the cause in this respect is the Fed increasing rates, and the effect is the trickle down consequence to the economy. Is it like 6 month, 9 month? What do you look at?
Yeah, so there's a few different ways to think about it. So the academic literature is kind of all over the place in terms of the number of months. But you can think about it, one, and this is how the Fed thinks about it, is through the financial conditions channel. So financial markets, so interest rates, as we talked about, equity risk premium, equity multiples, those start to price in expected rate hikes very early. And so we started to see contractions in equity multiples and rising interest rates in March of this year, even before the Fed started to hike. But the actual effects of interest rate hikes on the real economy take much longer. Short end rate increases are largely being repriced into credit cards, auto loans, kind of other short duration borrowing. But the long end of the curve, which affects kind of the broader corporate and household sectors, that takes a bit more time and depends on long-term interest rates. And so you start to see housing really decline first, and then you start to see corporate borrowing slow down at higher interest rates, and you start to see kind of corporate balance sheets start to get pressured by rising interest rates and rising interest costs. And so we're really starting to see the housing portion of it. And so you've seen the housing market slow pretty tremendously since kind of the peaks in the first quarter of this year. And going forward, we'd expect corporates to have more difficult times refinancing, margins again being pressured as they have to confront higher interest rate costs on their debt.
So with the Fed has a dual mandate of inflation and full employment. And at the moment, I think it's fair to say 100% of their focus is on that, is on half of that mandate, which is getting inflation back under control. I worry that they've painted themselves into a corner, and we've just spent the last few minutes talking about the lag of monetary policy and the consequences in the real economy. Are they going to be forced to just keep going and keep tightening monetary policy and almost by definition overshoot in terms of tightening until they begin to see some of the lagged effects of that earlier monetary tightening? Does that make sense?
Yeah, no, it makes perfect sense. This is the idea that they may, I think it's a popular narrative that the Fed's going to hike until something breaks. This idea that they are now looking at lagging indicators, the labor market, shelter inflation, particularly, that tends to incorporate rental price increases fairly slowly. And so with their focus on these lagging indicators, they're going to miss kind of the forward-looking picture that growth is slowing. The labor market should start to ease a bit, and inflation kind of in terms of forward-looking indicators should be coming down. The Fed's cognizant of this. The Fed, reads what market participants are telling them. The Fed understands the economy, just as well, and maybe even better than a lot of sell-side economists and other prognosticators. But they have painted themselves into a corner, because what ultimately grounds the 2% inflation target in the medium term is credibility in the Fed's willingness and ability to bring down inflation. And they think about that mainly through this inflation expectations channel. So the longer that inflation has remained elevated, the more under threat inflation expectations have become, as people start to incorporate thoughts that inflation will remain high. And so when they think about wage negotiations with their employer, unions, etc., they'll start to think, hey, inflation's been high, I need higher wages. And that kind of perpetuates this wage price spiral, which is what the Fed's very concerned about. And so I think the Fed knows that they've been far behind, but because inflation expectations are so critical, they have to respond a little more aggressively and possibly overshoot.
It's understood. So again, it comes back to that central case being a recession. It's by no means a certainty, but it sounds, like a probability for sure. So let's switch gears a little bit and go back to the UK, my home country. It's been a bit embarrassing being a Brit in the last 40, 50 days or so. It's been a complete mess. And we've seen the return of the bond vigilantes. I think this is amazing that essentially the bond market kicked out a government of a G7 economy. Let's unpack that a little bit. I think that, how unprecedented is that in a G7 economy? What are bond vigilantes? Where have they been? Why have they come back? Is this idiosyncratic to the UK? Is it a canary in the coal mine for other countries? We could spend, hours talking about this alone. But tell me, what were some of your reflections and observations from good old Blighty?
Yeah, I mean, so the most important part of it is, this was a shambolic policy mixture combined with extremely poor communication. You had the former chancellor and the former prime minister doubling down when markets were clearly telling them that this fiscal policies that they were unearthing were completely unsustainable. And so that lasted for a few weeks. You had a tremendous amount of volatility in the gilt curve. So that's the sovereign bond market for the UK.
Yeah.
And clearly markets were telling them that this fiscal policy is unsustainable and you need to change. You had the Bank of England coming in as the white knight to save the long end of the gilt market, and particularly pensions and other LDI, liability-driven investment funds. And so you've had this just completely shambolic mixture of policies. And in terms of whether it's a canary in the coal mine, this idea that with higher interest rates, fiscal policy and debt sustainability are going to become more in focus. I think there is some truth in that. The UK is certainly an example of, a very shambolic example of that. But if you look across the pond to Europe, you're seeing more spending from Germany, you're seeing more energy price guarantees across the euro area, and you're seeing more intentions to spend, particularly on the defense side, given the threat posed by Russia. So there is a stronger fiscal impulse in Europe, and we think it's for the right reasons. It's to support demand, it's to offset, this very tragic shock that's going on in the Ukraine and what it's doing to energy markets. But more globally, the fiscal impulse is actually turning negative. And, the largest driver of that is the US, who has really shifted away from the pro-cyclical fiscal policy coming out of the pandemic, especially the most recent packages this year, into kind of declining fiscal spending in the out years. And China has been very restrained in terms of thinking about whether to increase fiscal spending as they suffer through pretty, dramatic growth slowdown.
So we'll shift gears to China. You mentioned China. We'll shift gears there in a second. I suppose my silver lining with the UK is it was so shambolic. They committed such a catastrophic mistake, but the markets functioned in that this mistake was corrected in a pretty short space of time. So yes, the UK's got its third prime minister in less than 50 days. But what's your take on Rishi Sunak? He's only a few days in now, but it seems that the bond market, the currency market has given him a vote of confidence. Is that fair?
Yeah, I think that's completely fair. And there's been positive spillovers to the rest of the world as well, because, especially global bond markets are, internationally linked. And so what happens in the UK spreads to the German bond market, spreads to French debt, spreads to Italian debt, spreads to US debt. And so there's this common pricing factor across sovereign bond yields. And so as the UK has shown more fiscal rectitude over the last few days, you've seen, broader rates decline. You've seen less risk premium and less concern about this fiscal easing.
Got it. Right. So let's shift to our last topic, which is China. And out of this weekend, we saw the controversial conclusion of the 20th Chinese National Congress meeting, which happened every 5 years. But can you just explain to all of our viewers, what is this? Who's there? Why is it important? What does it mean? And then let's dig into a little bit about some of your takeaways from this most recent one.
Sure. Yeah. So the 20th Party Congress, in a nutshell, it's a gathering of all the senior most members of the Chinese Communist Party. It happens once every 5 years. They elect a new chairman, they elect new members of the Politburo Standing Committee, as well as the Central Committee, which is kind of a 200-person body of fairly senior leaders in the party. The most important thing that we learned is Xi Jinping is taking an unprecedented third term as chair of the party. And so since Mao, beginning with Deng Xiaoping in the late 70s, early 80s, there was a big departure in the Chinese Communist Party away from this cult of personality that had characterized the Mao years and unleashed a lot of terror on its citizens. And so Deng and other senior party members began to think of policymaking in China as a kind of communal, committee-driven process.
Yeah.
And so Xi taking on a third term and beginning to consolidate power quite severely with members he's promoted below him shows that we may be returning to this cult of personality, individualistic Chinese policymaking.
And so with President Xi, there was also a pretty negative reaction from the markets on Monday. What was your take there? What are our views on China? Are you seeing any opportunities?
Yeah, it's hard. It's clearly a knee-jerk reaction, and I think the direction is right in the sense that the risk premium should be rising in China because the shift towards a third term for Xi and probably a fourth term in the out years really marks a shift away from the pragmatism that described Chinese Communist Party over the last 40 years towards this more political ideological bent. And if you look at the people who Xi promoted around him, including the new premier, there's very little experience in economics, finance, other kind of skill sets that have really characterized senior leadership over the past 40 years. And so the fear is that this more ideological policymaking slant will lead to more frictions with the rest of the world, whether that's in technology transfer, as you can see the Biden administration starting to be more aggressive on semiconductors and other technology curbs, whether it's their close relationship with Russia or more aggressive posturing in defense, whether that's the South China Sea islands or even with Taiwan. It's a more assertive, nationalistic, and ideological Chinese Communist Party, and that just makes for more frictions with the rest of the world.
I think it's a good point to finish on, that politics and especially geopolitics really matter again in investing, and this relatively sort of benign period of a few decades of ever more globalization and sort of shrinking, if you like, dispersion between countries is well and truly over. And geopolitics, really do matter again. We talk there a lot about China, but it's not just China. There seems to be this sort of move to being more local and more insular. And I think again, we could spend hours talking about the weaponization of semiconductors and what that ultimately means for politics and for investors as well. So Jake, last question for you. As a portfolio manager, you're our head of fixed income. What's the first thing that you look at in markets like every day? What is it that you're looking for? How do you spend some of your time?
Yeah, I mean, it's beginning with the U.S. 10-year. That's kind of, it's the benchmark risk-free interest rate for the world. So where is that going? What is the correlation of that with equity markets? What are we seeing in the dollar? We begin with these kind of top level macro assets, and then we kind of work our way down. Well, is there something in the dispersion in equity returns that is informative? Is there something in the dispersion in credit returns? Is there, what is it emerging market currency returns telling us? And so, you begin with the most important pricing kernel, that's the US 10-year, and you kind of work your way down the pyramid.
Well said. All right, Jake, thank you very much for your time. Really enjoyed that conversation. And I hope everybody enjoyed Views from the Harbour. If you have any feedback, any particular topic items you want us to go deep on, please don't hesitate to get in touch. With that, thank you.
Thanks so much.